So, title of the talk, Learning the Best Buy-to-Let Strategy for 2020 and Beyond, presented by me. I'll tell you a little bit about me to start off with, I suppose. So my background is financial advice and financial planning. I previously ran a large financial services company in Australia that we publicly listed in 2014. So that was full service financial advice across all areas, and part of what we did was property. I've personally invested in pretty much everything there is to invest in. I've built a reasonably sized property portfolio, both buy to let. I've done some renovation stuff and some development stuff. I've been involved. I'm currently I'm currently in the process of buying 6 properties at the moment. And over the years, I've been involved in thousands of property transactions with our clients. So I've seen what works. I've seen what doesn't. I've implemented our own methodology personally and with thousands of clients. So hopefully I know a thing or two about what I'm talking about. I've also got various businesses across the property industry, e-commerce, health and fitness. So hopefully, again, I know a thing or two about running a business. So I talked to you about some of those experiences and how we implement them for ourselves and for our clients. I've also written a best-selling book on the topic. So that's the Property Pension Plan, which is an international bestseller now on Amazon in the UK and Australia, and effectively talks through what all of your investment options are and why we feel as though leveraged property, which we'll talk more about in a moment, is a very good option for a very broad range of people to best utilize their resources and build an investable asset base to provide for retirement, essentially as an addition to or alternative to a traditional pension, because obviously traditional pensions have some limitations. So that's a good it expands on everything that I cover in today's talk and is a good roadmap or refresher for anyone really, so far as building toward achieving financial goals and financial freedom. And I'll provide you all with I will provide you all with a link at the end of the talk so that you can get a free copy of that book. So, bit of housekeeping to start with. We're a regulated company, so it's important for me to say that anything that I cover in today's talk is general in nature. It's not specific to you. You shouldn't therefore necessarily act upon it. You should seek personal advice before making any changes to your finances or investments. And that is something that we can help you with on a one-to-one basis. So after this webinar, each of you will receive the opportunity to have a free consultation with one of our senior client advisors, which is a good opportunity to get a review on your situation and determine whether we might be able to add any value and help you improve. So we'll talk more about that at the end as well. That ties in quite well to the next point. If there is anything that doesn't make sense in what I'm going through here, any terminology I use, or any questions you have in general, please ask them. As I say before, a question that's on your mind might be on other people's minds here as well. So you might actually help some other people by asking that question. And I think it's worth having that question and answer discussion in this open forum. However, if it's more of a private point or you're more of a private person, you will have the opportunity to have that free one-to-one consultation. So there's going to be ample opportunity to clarify how the things I'm talking about are relevant to you. So don't worry if you feel a bit like this guy drinking from a fire hydrant. You're going to have the opportunity to clarify things. Right, so agenda for the talk. I'll start off by introducing Nova. I can see some familiar names here, so I know some of you are already familiar with our business and others perhaps aren't, but I'll describe that so that you understand the direction from which we're approaching this, because I think that's important. I'll talk about the importance of strategy. So this is not necessarily just connected to property, but what we have found is a lot of people that invest in property tend to do it very ad hoc and not really with an investment mindset. I found in my experience anyway, people that invest large sums of money in the share market tend to get advice when they do it because they understand they're not experts in valuing companies and building a portfolio of shares across different companies. Whereas I found in general, most people when it comes to property, speak with a local estate agent, buy properties here and there when they feel like it, but have never really put in place a solid strategy. And that's one of the first things that we help our clients with. Why leveraged property? The key word there being leverage, the ability for debt which is really the differentiating factor. What makes property so attractive is the ability for long-term cheap debt, which multiplies your buying power. So we'll talk about that and some of the returns that can generate. Risk versus reward and how we want that skewed in our favor. Some of the key fundamentals, the boxes that we look to tick to give us confidence in the right outcomes from property investment, and then some 5-year predictions on growth. Right, so first off, Nova Financial Group. So that's essentially the overarching brand under which a number of different companies sit, all of which work quite closely together. But how we assist clients is, first off, helping them better understand their current situation and their goals. So, where are you now? Where do you want to be? What's the best strategy for getting there? And one of the first things that we do in that initial consultation that I referred to is a full review of your current situation. So actually writing everything down: your home, the value of the debt; your investments, the value of the debt; any other assets you might have, any other debts you might have; your net investable asset base, therefore, excluding your home, because your home doesn't generate you an income, is X amount. This is where we are now. And then what are your goals? What's the yearly income you need to achieve to live comfortably? What sort of investable asset base do we need to generate that yearly income? And therefore we have point A, we have point B, and we know what the shortfall is. We also then need to understand what's the time frame for making up that shortfall. And that gives us a starting point in understanding what the right strategy might be for you. And I found that most people haven't done that. So, at the very least, take advantage of that free consultation, and that will enable you to do that and have a clear understanding of your current financial position, where you want to be, and what the shortfall is for getting there. And that's where is it very urgent that you take very urgent action and start making positive change, or do you have time on your side? Once we understand those things, then we can start to put in place a strategy. We then need to implement that strategy by actually taking action. So we do all the research and due diligence with regards to sourcing the right properties in the right location. So finding the properties to buy, sourcing them. We then have an in-house mortgage brokerage, so we advise on and arrange the finance. We have property management services UK-wide, so we manage the properties. And then we work with our clients on an ongoing basis to help them review and reinvest when it makes sense to do so. So actually building the portfolio and working toward achieving those financial goals. So in a nutshell, that's our business and our service. It's very much an end-to-end service. We bring in-house a number of different services that usually you would need to source from different companies. What makes us different is our financial advisory approach to property. So it's not so much about the properties. We couldn't really care less about the south-facing garden unless that's relevant to your target market. It's much more about the financial outcomes of investing in property and using property as the vehicle for achieving financial goals. We also are independent, meaning we don't have any properties or investments to sell. Everything we do is bespoke to the individual, and it comes down to what we feel as though works best and best fits their criteria. So that's the biggest point of difference. We don't have anything to sell, and we're not estate agents. We don't just flog properties. It's very much bespoke to each individual, finding the right thing for you. Qualification and experience. Well, I'm a qualified financial advisor and mortgage advisor. I've been in the industry for about 12 years now, and I'm supported by a team with over 100 years of experience across property and financial services. So hopefully we know a thing or two about what we are talking about. We've also got very strong relationships and a strong network throughout the UK property market, which gets us access to the better opportunities, and we can leverage our buying power. Our clients invest in about 30 properties a month through us on average. So we can that gives us more buying power than most in the industry, and we can leverage that to position our clients in the best possible way. Right, so that's us in a nutshell. Strategy. So I mentioned point A and point B. This is where you are now, this is where you want to be, and then we need to work out the best way of getting there. A lot of people invest in property without a strategy, as I mentioned, and an analogy I sometimes use for that is it's like jumping in your car and driving aimlessly. You're probably unlikely to end up somewhere desirable, and even if you do, it's only by mistake. But even if you know what the desirable location is, where you want to be, if you don't know how to get there and you don't have a roadmap for getting there, then you're probably fairly unlikely to get there. And I think that's very relevant to investing as well. If we're just acquiring things ad hoc and, saving money and then buying things as they come up, but not really having any clear criteria or framework for how we're going about doing that, then we're probably fairly unlikely to make the right decisions. So by having a strategy enables you to remove the guesswork, gives you more peace of mind, accounts for contingencies. If you're doing it through the means of getting advice, like working with Nova, you're able to benefit from years of experience, and therefore, other people's mistakes that they've made in the past, you don't need to make them. So to me, it doesn't make an awful lot of sense to try to put in place a strategy on your own as an individual with limited experience, when you can put in place a strategy based upon, thousands of property transactions and having seen what works and what doesn't. So that just makes sense to me, to take advantage of resources that are available to you. It enables you to take a business approach to investing in property. I think most people who know what they're talking about when it comes to property these days would agree with me that property investment is no longer a hobby. It's not just a side thing. You can't just buy the property at the end of your street and expect to make loads of money. There's a bigger difference between what works and what doesn't, especially when you consider things like Section 24, the stamp duty premiums, mortgage serviceability changes. 3 pretty big changes in the market over recent years. And what that's done is it's caused a bigger gap between what works and what doesn't. And strategies that worked 5 years ago may not work as well now. And strategies that didn't work as well then may work better now. So without understanding that and how that relates to you, it's going to be very difficult to make sensible decisions. So that's another point that worth thinking about. Now, there's a good example as to why goal setting is important. And there was a study done of the Harvard MBA class of 1985. It's going back a little while, but it's still very relevant. They asked them, do you have clearly defined goals? And are they written down? 3% did. 17% had goals, but they weren't written down. And 80% didn't have any clearly defined goals at all. 10 years later, they surveyed the same group of people, and the 3% were earning 10 times as much as the 97% combined. So the moral to that story is that simply the act of sitting down and writing out your goals, clearly defining them, and some sort of understanding of how you're going to go about achieving them, gives you a far better chance of actually achieving them. I'm not talking about sort of asking the universe and you will receive here. I'm not talking about spirituality. I'm talking about, a very practical approach of simply committing pen to paper and understanding what your goals are and how you're going to go about getting there, as opposed to them just being up here. So then I've got another question for you all now. Who at the start of this year, we'll just use the chat section again, who at the start of this year sat down and wrote out their goals for 2020? I know it's been a bit of a bumpy year, but we didn't know that in January. So who sat down and wrote out their goals? If you don't mind just responding to me in the chat section. Okay, a few people did. That's good. More yeses than no's. Definitely more yeses than usual. Pretty much everyone did. Come on, there's got to be some no's. Tell the truth. I'm sure there's some no's there and people aren't being honest. For the people that didn't, and good work to the people that did, because I think it's definitely worthwhile. It's pretty much a fact that writing out your goals does help. There's been so many studies that it gives you, so many multiples of chances of actually achieving your goals if you do this. So I suppose if there's one thing that you take from this webinar, take some time out, whether that be this evening with your partner, or it's probably worth, if you're in a relationship, it's probably worth doing it with your partner, assuming your finances are combined. Sit down, take 5 minutes, 20 minutes, an hour, however long it takes to actually sit down and write out your goals, because it's definitely worthwhile doing. Or, for example, get in touch with us. You're each going to receive an email and a text following this webinar, giving you the opportunity to have that free one-to-one consultation, and we'll go through that process with you to help you put that in place. Because I think it's definitely worthwhile. What have I done there? Oh, here we go. Good. All right, now on to property. So why leveraged property? So leverage being debt or mortgages, the ability to multiply your buying power. So I use the example of a 50 grand deposit into a £200,000 property. So a 75% loan to value mortgage. Effectively what we're doing there is quadrupling our buying power because we're turning 50 into 200. Now, what that means is by achieving relatively average returns on the 200 grand, we can generate fantastic returns on our 25% deposit or our 50 grand. So let's look at some numbers on that now. What we're generally aiming for and achieving in the current market is a minimum net yield on funds applied of 5% and usually up to about 10%. Sometimes a bit better, but usually it's somewhere in the middle. And that creates a nice little cash buffer. So that's on your 50 grand investment. And I would encourage you to always look at property investment as on a basis of the returns on your cash, as opposed to the returns on the property. I'd say most people probably look at more so at the returns on the property, but that's almost irrelevant when you consider the fact that it's your 50 grand that you are contributing. Now with that 50 grand, you could put it under your bed, you could invest it in shares, you could put it in the bank. It just so happens we've decided to invest it in this particular property with a 75% mortgage. We haven't invested 200, we've invested 50. We borrowed the rest and we plan to pay it back at some point. So always look at the 50 grand, the returns on your 50 grand. So 5 to 10%, using that example, that would be £2,500 to £5,000 of net cash flow. So post expenses, pre-tax. So that's after servicing your mortgage, after management, or whatever costs go into running that property. Obviously, it's different for different types of properties, but whatever that might be, we've paid for all that, and this is actually cash going into our pocket. So that's nice. It creates a safety net for contingencies, but £2,500 to £5,000, especially when we're talking one property, isn't going to substantially change your life. What does contribute greatly to improving your financial position when it comes to property investment, if done well, is capital growth. So the UK average for capital growth over the past 20 years is 5.5% per annum, so per year. Now, over that time frame, we've had two recessions. We had one in 99-2000 being the dot-com bubble, with another one in 2008-2009 being the credit crunch. So the property market's dipped a little bit over those timeframes, not an awful lot, but a little bit. Even after considering those dips, we're still at 5.5% positive per annum. So it might have been 8% one year, 3 the next, -2 the next, 9 the next, but overall it's 5.5. So pretty steady positive growth when you consider the average figure. Now, if we scale that back slightly to 5%, just be a little bit more conservative. 5% on the asset value or the property gives us 20% on our cash. So let me just put that another way. A £200,000 property that increased in value to 210,000, therefore 10 grand equity created, gives us a 20% uplift in value on our 50 grand investment because the equity goes from 50 grand to 60 grand. Now that's a fantastic return. And how we access that return is by remortgaging and reinvesting. So every time there is accessible equity in the property, we remortgage it, we release it, and we turn it into two properties. So if we put those two figures together, we're at 25 to 30% returns per annum. And I'm yet to hear a logical argument that tells me that's a bad return on a yearly basis. It's not. It's a fantastic return. But what's really interesting about that is we're generating that return without setting the world on fire with regards to the asset value returns. So we've got the 200 grand property giving an average UK property return, but that's giving us a fantastic return on the cash we've put in on a net basis, which is really, really good. And what that says to us is that property investment or sensible property investment isn't necessarily about maximizing returns. We don't want to take too much risk and therefore try to get too much better returns than the average. What we want to do is invest in properties, good properties in good locations that we're very confident are going to consistently give us that return over a 7 to 10 year plus period. We'll get on to some of the ways of having confidence in that in a moment. But if we look at that over a 10-year period, we're at 250 to 300%. So we're tripling our money over 10 years, which is obviously quite good, without really doing all that much for that return. But if we take that back to 3 or 4 years, that gives us 100% return. So that's when we can take back our initial investment. So based upon this average uplift in value, we should be able to remortgage our property every 3 to 4 years to turn one property into two, two into four, four into eight, and so on and so forth. So if we look at that over a 10 to 15 year period, it's actually quite achievable to turn one property into 8 properties, depending on performance, being the 10 to 15 year time frame, and therefore turning 50 grand into 400 grand. Now, that's just by an initial investment of 50 grand. Of course, if you're investing multiple lots of money over a period of time, for example, some of our clients will buy a property every quarter, or they'll buy a property a year, or they'll buy a property every 3 or 4 years, depending on your ability to save money, determines how quickly you can do this. But if you do that 3 or 4 times, you're turning 200 grand into 1.6 million. So you can see how that can have a pretty big impact over, yes, a 10, 15, maybe even 20-year period, which is a long time, but not a long time in the grand scheme of things when we're talking about a fairly substantial amount of money that we're creating relatively passively. So that's quite interesting. And how we get confidence in actually getting that on a consistent basis is ticking as many of these fundamentals boxes as possible. So first off, we want a large tenant pool and strong tenant demand. The biggest risk with leveraged property is being able to service your mortgage. Falls in price or property value falls aren't really that much of a risk because they happen, especially good properties in good areas, they only really happen over the short term. Prices will dip a little bit, then they'll recover. And as we've just talked about, 5.5% positive growth being the average across the whole country. If it's a good property in a good area with the right driving factors, we can be confident it's going to increase in value over the mid to long term. So that's not too much of a risk. The main risk is being able to maintain the mortgage. And the easiest way of being able to maintain your mortgage is always having a tenant. Because if you always have a tenant, you're always receiving rent. And if you're always receiving rent, you can always service your mortgage. So if we're investing in very tenantable properties, very rentable properties with low vacancy rates and strong reasons for people to want or need to live there, then that gives us, that creates a lot of safety. Because, even if the price of your property does fall over the short term, you're still receiving rental income, you're still receiving a positive net yield, and therefore you're probably still in positive returns territory as well. So that's interesting. So that's important. Now, how do we have confidence in these things? One of the main reasons that any of us live anywhere is being relatively close to work. So we want a broad range of industries, providing a broad range of employment. What you don't want, in my opinion anyway, is be investing in a location that's driven by one industry or even worse, one company. Because if that's the case, if that industry or company moves or goes out of business, then that will significantly affect the demand for properties in your location. So smaller cities and towns around the UK, in my opinion, are more risk because quite often they are majority driven by one industry or one company. And that's quite risky. We've seen that happen over the years. The steel industry in Sheffield dried up, therefore all of the jobs dried up in Sheffield. And there's various other examples. Infrastructure is the both large and small, large being roads and rails, small being shops, restaurants, bars, cafes, effectively the facilities and amenities that people want and need. Especially the latter, the smaller infrastructure, is becoming more and more important for young professionals. It's a bit of a generational shift, I think, that young professionals these days want everything on their doorstep. In the past, that wasn't as much the case. If we look at the baby boomers, for example, as a generation, they were more family oriented. They had children earlier, they got married earlier, they worked shorter hours. They wanted the large family home with the garden and the picket fence. That's not so much the dream of young professionals anymore, but, the baby boomers of a generation, they were willing to live further from the center of town to achieve that dream. Whereas, that's not so much the case anymore. And I'd say this is probably, in my experience, people like in their sort of mid-30s down have quite a shift in thinking. It's something that I relate to. I'm talking to you now from Zone 2 London. Our office is in the city, which is a 10 to 15-minute commute away. And there is an abundance of facilities and amenities around here, which is why I like living here. For the price of this place, we could move a few miles away and get a much larger property. But I'm not really interested in that because we wouldn't have the same sort of things on our doorstep. We'd be further from work, all that sort of thing. And I think that's quite a common shift in preference. So that's important to understand. Socioeconomic levels, so the demographics of your target market. Understanding who your target market is. So who you're going to rent to, who you're going to sell to, average incomes, unemployment rates, vacancy rates, all the statistics. So the Office of National Statistics is a good source for that information. But perhaps more important is understanding what that target market wants. So where some people can go wrong is buying in a good location, but the wrong type of property. So for example, a family-oriented area, buying a one-bedroom flat in that area probably doesn't make that much sense if the average household makeup is 3 or 4 people, and most people are living in 3 or 4 bedroom houses. Vice versa, buying a very large property in a city centre, for example, where most people are either living on their own or living as couples, can affect its performance. So you want to make sure that the preference and the types of properties in the area are skewed toward the type of property that you're buying, because then you can have confidence in demand. Having a good balance between yield and growth prospects is increasingly important, especially when you consider things like Section 24 and the mortgage serviceability changes. These have put more of a spotlight on the importance of yield and having a yield buffer in your portfolio, as opposed to just breaking even and achieving growth. So you want to have a good balance between the two and kind of get your cake and eat it in that regard. In fact, what we're looking for here is positive growth and change. So positive catalysts for change that are going to contribute to a location doing well. And I quite often talk about the UK property market being made up of many microclimates, the individual locations that are driven by individual driving factors. And something that annoys me sometimes when I see people talk about the direction of the UK property market, because whether the UK property market goes forward or backwards by 5% or 10% or whatever this month or this year doesn't really matter or have that much relevance to us as individual landlords, because we don't buy the UK property market. We buy individual properties in individual areas. No one has enough money to buy the whole market and therefore have an even spread. So, if you're thinking about an investment, that investment shouldn't be determined by what the UK property market is going to do this year. It should be determined by, are there good opportunities within the UK property market and what are they going to do this year? I'll give you a good example. A location where I've just bought a couple of properties and our clients have bought a few hundred over the past 12 to 18 months. I was actually there yesterday, is Digbeth in Birmingham. So Digbeth is a sort of small, underloved town in southeast central Birmingham. It's a 5-minute walk to the centre of the city. For those who aren't familiar with Birmingham but are with London, it's kind of like Shoreditch 10 to 15 years ago. It's about 20% cheaper than the rest of central Birmingham, and it's a bit rough around the edges, but it's gentrifying very quickly. And there is literally billions of pounds being spent there at the moment. And I think people use that word flippantly sometimes, billions, but it's a lot of money, and you can't spend that sort of money without it having a positive impact, especially when it's being spent on a small, underloved town. So, Lendlease, for example, is doing a £1.5 billion redevelopment there, which pretty much extends the city centre into Digbeth. And there's various other things happening. So I'd be very confident in saying that even if the UK property market goes backwards by 5 to 10% over the next 12 to 18 months, Digbeth's very likely to move forwards by a similar figure, regardless of the direction of the overall market, because of the individual driving factors that are occurring there. And it's not the only area. I'm also buying a property in Salford at the moment in Manchester, very well positioned between the city centre and Salford Quays. Again, it's cheaper than the city centre and Salford Quays, but is being squeezed by those two areas growing quite quickly, and therefore lots of gentrification taking place. So that gives you an example of the types of things that we look for. Two examples of being right on the fringe of a city centre at a better price, but with lots of gentrification happening. And therefore, that gives us confidence in performance over the short, medium, and long term. Right, risk versus reward. So we always want this imbalance in our favour. One of the ways of doing that is investing in location with very low vacancy rates. Generally, you'll find the focal point for the lowest vacancy rates, and also the focal point for all of these factors I've just covered, tends to be the centre of and surrounding areas of major cities. So for example, London ticks all of these boxes. The boxes London doesn't really tick, though, is prices are very high and yields are very low. And therefore, when it comes to finance and the ability to get higher levels of finance, you're quite limited in London now. So it's harder to justify a buy-to-let investment in London when you run the numbers on a leveraged model. Places that it's much easier to justify, in my opinion, and I'm certainly putting my money where my mouth is here, because I'm in the process of buying 2 properties in Birmingham, 1 in Manchester and 1 in Liverpool, as well as 2 in Cambridge, is the centre of or surrounding areas of those major cities. Much cheaper property prices, much higher yields, therefore you're getting a much better yield buffer and arguably more growth potential, because the affordability is much better, and comparatively there is more going into those cities from a sort of infrastructure and positive growth and change perspective. So there's some of the ways that we can look to mitigate the risks, but position ourselves in a good way to benefit from the reward. Fair value, and the reason I use this term fair value as opposed to below market value is, I think, first off, that term below market value, or BMV, is way overused. It's a bit of a buzzword. It's quite often used as a sales tool or a marketing tool to sell properties and make them look cheaper than they actually are in comparison to comparables in the area. So quite often it's not true. It's not real. Sometimes it is real, and sometimes we can get fair value properties that I suppose arguably are below market value. But my point is, in my experience, the property where you begrudgingly pay fair value or perhaps more than you would have liked because lots of people wanted it for good reason, will usually outperform the property that nobody wants, and therefore it's cheap. Now, I suppose what I'm talking about here is, because there's no one size fits all here, I'm not saying this is the only way to go about investing in property, but what I'm talking about here is more passive investors. So most of our clients are what I would call mum and dad investors. They quite often have a job, usually quite a busy job. They quite often have a family, which kind of takes up the balance of their time. They've got spare resources, but they don't really have time, and they don't want a second job. Now, for that person, they want to invest in quite passively. They want a turnkey solution. If you're a full-time landlord or property person, or a builder or a developer, then perhaps there are different opportunities suitable for you than what I'm talking about here, because you can take an asset that's underloved and turn it into something that's desirable. For example, what I'm doing in Cambridge at the moment. But I live and breathe property, and I've got pretty strong resources behind me. Therefore, my risk appetite's higher. What I would encourage people to not venture into, without thinking very hard about it, is the property development side of things. If you are what I would just describe as mum and dad investor, because if you don't have any spare time, it's really not for you. You need spare time, you need strong resources, and you need to have a bit of a higher risk appetite to get involved in that thing, in my personal opinion. You need to have the time available to make it work, because no one else is going to make it work for you. So if you're a passive investor, you need something that's ready to go and desirable. If you're a bit more hands-on, then you can go for something that perhaps is undesirable now, that you're confident you can turn it into something desirable. The importance of a yield buffer, so that creates safety, and effectively what we're looking to invest in is tangible assets in desirable locations. Right, so some of the current market trends. So first off, substitution of space for place. So I mentioned this before, the idea of being in a desirable location, perhaps taking on a smaller property than people in the past would have had a preference for, to be in that location. You know, for example, city centre or city surrounding living, you're usually much smaller properties than further from the city. And there is a very strong trend toward that sort of thing. More city centre living, younger generations moving or staying north. So there's been quite a bit of media around this, so it probably isn't a surprise to a lot of people, but I've found it has been a surprise to some, is that the transient population within the UK is stronger to the north than it has ever been before. You know, not so long ago, about 20 years ago or so, the cost of living in London was much lower, and wages comparative to other cities was much higher. And therefore, people moved to London for the money. However, places like Birmingham, Manchester, Liverpool, you can now earn very similar money there to what you can earn in London, but the cost of living is substantially less. As I say, I was up there. I was in Birmingham yesterday. We stayed there on Monday. We're there Monday, stayed Monday night, came home last night, and you know, you go out for a meal there, and it is very noticeably cheaper. Even in the same restaurants, we went to Piccolino's, which we go to in London all the time, and Piccolino's in Birmingham is cheaper than Piccolino's in London. Pretty noticeably. So you can see, it's not just nights out, but you can see property prices. You know, for 300 grand, you can buy a centrally located penthouse in Birmingham. For 300 grand in London, you're lucky to get a car space. So big difference. And therefore, for young people with limited resources, I can see why, you know, a graduate that works for us in the city in London, it must be hard for them just to live based upon a graduate wage. But it must be even harder for them to foresee getting onto the property ladder. Whereas in those cities, it's much more achievable, and therefore you can see why it's happening. So a lot of people are moving there or staying there if they're from there, or they're going there for university and they're staying there after university. So the postgraduate retention levels in the likes of Birmingham, Manchester, Liverpool have been substantially higher over recent years than ever before. I suppose because those cities, they're just more livable now than they were in the past. More of a focus on yield. High value properties are struggling. High value, low yield properties are struggling in the current market after things like Section 24, stamp duty changes, and mortgage serviceability. Lower value properties with a higher yield are benefiting from that. It's caused quite a shift in the market, a noticeable shift. You know, most of our clients are based in London, given our head office is in London, and we've got lots of clients overseas as well. So London clients and overseas clients in general had a strong preference for London. And we've noticed progressively over the past sort of 3 or 4 years, that preference has dwindled, and they've become more open to investing in other locations after noticing that, you know, first off, it's very expensive to buy in London, but also I think it's just a more commonly accepted thing that those other cities offer some good opportunities. And there is definitely safety in desirable centrally located properties. Some of the current market trends. So predictions on growth. This is a graph from Savills. I think 2020 is a bit up in the air. It's interesting to see that we have had some positive growth in 2020. The economic lockdown caused everything to go on pause. The markets bounced back quite strongly from there. I think there was definitely was some pent up demand, people wanting to buy but not being able to. We had the strongest month for transactions this year was July. And I think that was the case for most property businesses. You know, people were actually buying properties. Everybody had a busy July. August, things were good, but not as good as July. And it'd be interesting to see what happens over the next 6 to 12 months. But the point here, when it's backed up here by the numbers, is what happens over the next 6 to 12 months is almost irrelevant, because COVID-19, we don't know how long it's going to last, but regardless of how long it lasts, it's still going to be relatively short term. Even if it's a year, 2 years, 3 years, in the grand scheme of things, that's quite short term. When we're investing over a 10-year plus period, that's a short-term thing. So if we're investing in good properties, in good areas with strong driving factors, we can be confident that short-term fluctuations aren't going to affect us all that much. And what's interesting about that is pretty much all the research houses, not just Savills, are predicting some fall in prices across the overall average UK market over the next 6 to 12 months. But what most of them are saying is that they don't expect that to affect 5-year growth at all. So therefore, I suppose they're subscribing to the V-shaped recovery model. So prices fall a little bit, They recover quite quickly and some. So effectively making up for that fall in pricing. Now, some people might say, well, therefore, shouldn't we just wait, get properties at the bottom of the market? Which, yes, of course, you could. But remember, property prices, the average property price, things don't move at the same speed. So if you're looking at good properties in good areas like Digbeth that I just mentioned, I'm pretty confident property prices aren't going to come down there at all. In fact, they'll probably rise, even if the average in the UK are going down. So if you're looking for the right things in the right areas, you might be surprised that prices don't fall at all, or perhaps even increase. And therefore, you've missed an opportunity by sitting on your hands. And for example, some people have asked me about these figures that we went through here. We spoke about 5% growth per annum. And can you be confident in getting 5% growth this year or next year? And the answer is it doesn't matter, because even if you get minus 2% growth this year, it's likely to make itself up over the coming years. Because remember, we're talking about a 7 to 10 year average. So it doesn't matter about when you invest. It's about actually investing and being in good properties in good areas with good driving factors and having the confidence that's going to perform well over the mid to long term. That's really what it's all about, rather than timing the market. And there's a quote I'm quite often quoted on. I'm sure I've stole it off someone at some point, but it's very much mine now, is that property investment is not about timing the market. It's about time in the market. So if you've got spare resources, put them into good properties in good areas where we're confident they're going to do well over the mid to long term. What happens over the next 12 to 18 months, so long as you've got a tenant, which you can be confident in having if it's a good property in a good area, regardless of the economic cycle, it doesn't matter what happens to the property prices over the short term, because we know they're going to go up over the mid to long term. Hopefully that's useful. Right, so I mentioned at the start of the talk that we were going to be offering a free consultation for everyone. I also mentioned we're going to do a promotional offer where we waive some fees. So how that works is after this webinar, you will each receive an email and a text message offering you the opportunity to have a free one-to-one consultation with one of our senior client advisors. Now, first off, that will be a 5 to 10 minute phone call to see if there's the potential for a mutually beneficial relationship. And hopefully there is. At that point, if there is, we do the initial consultation, which is 60 to 90 minutes. That's free. It's a full review of your current situation, your goals and preferences, the shortfall for getting there, ways in which you might be able to improve, and an understanding of our business structure and to see whether there's a fit there. Now, if there is a fit, we usually charge a fee of £500 to £2,500 to engage with you and generate advice on how you can improve. So what we're going to do is waive that fee for all the webinar attendees. There won't be a fit for everyone, but hopefully there's a fit with quite a few of you. We can generate that advice. Now, that's on average 10 hours work specific to you on how you can improve your financial position, your build on your property portfolio. So very, very little for you to lose and potentially a lot for you to gain. At the very least, you get an understanding of the best strategy for you to then go off and implement yourself. At the best case, we keep working with each other and help you build the portfolio and actually achieve those goals. So please do take advantage of that. And hopefully that can be of benefit to some of you. I also mentioned about the book. So this is what have I done here? This is our website. 1 second. This is our website, nova.financial. I'll put the link in here. You can find out a lot more about our business at this link. For example, there's lots of educational resources. We've got, I host a TV show on Sky called Proper Wealth. I feature on another one called Property Question Time. We've just filmed another one called Property Elevator, which is pretty much the dragon's den for property developers. I'm one of what they call the angels, the panelists. So that will be on here soon as well. That goes live at the end of this month. So lots of information there. We have over 100 hours of educational video. So lots to sink your teeth into if you're interested. We've got 2 podcasts. We've got ebooks. We've got the book, which I mentioned. So the book goes through all of your investment options, not just property. So interest-bearing investment, shares, property, benefits and pitfalls of each, contrasts them all, goes through traditional pensions, some of the limitations of those, and the idea of building a property portfolio to achieve a certain level of passive income per annum to live comfortably. So expands on a lot of the points I've just covered in this talk. So that's to get a hard copy of the book, and all you have to do is pay for postage, which is £5. It's usually £15 plus postage on Amazon. I did this same webinar earlier today, and a chap in that webinar said that it's one of the best books he's ever read, and he's reading it for the second time now, which is the first time I've heard that someone was reading it for the second time straight away, but it was nice to hear. So we've had very good feedback on it. So that's the book. That's for the hard copy. If you prefer listening to books, then you can get it here. It's on Audible. So that's the Amazon audio book platform. So there you have the website, the hard copy of the book, and the Audible version of the book. So feel free to sink your teeth into that. If anything that I've said here is interesting, then you should find that interesting as well. Good. So some questions now. Okay, so a question from, I hope I say this right, Babor, hopefully I pronounced that correctly. Is it a good idea to borrow money on a remortgage to start buy-to-let considering current COVID issues? All right, so good question. And I assume what you're talking about is remortgaging your home to release some equity and start out in buy-to-let. And in general, I'd say that is a good option. The reason I'd say that, and this isn't necessarily specific to you, we need to find a bit more about your situation, but in general, it can be a good option because we find that a lot of people have a substantial amount of their wealth tied up in their home, but your home doesn't generate you an income. It's not part of your investable asset base. It's just your home. It's a personal benefit. It gives you somewhere to live, but unless you're planning to sell it and downsize in the future, then you need to, quite often, people need to access that wealth that's stored in their home. And the best way of doing that is remortgaging it, taking some of that equity and investing in property. Now, you said, considering current COVID issues, currently, interest rates are the cheapest they have ever been in the UK. So the debt is very cheap. And going back to what I mentioned before, COVID, I'm very confident in saying, will be quite short term. Whether it be 1 year or 3 years in total, so far as its impact, it will be short term. And therefore, in the grand scheme of things, it's almost irrelevant. So long as you're buying properties that you're confident will rent, don't worry about the short-term impacts of this current recession, because recessions have happened before. The fundamentals I explained to you in those slides are almost recession-proof, because if you've got a tenant, it doesn't matter. Doesn't matter what happens to the short-term value of your property. So long as you've got a tenant and you're servicing your mortgage, you can still be confident in doing well over the mid to long term. So I wouldn't worry too much about the current situation, so long as we're buying good, very rentable properties in good areas with strong driving factors. There's still lots of good opportunities to be had, especially when you're thinking mid to long term. So happy to discuss that with you in more detail, or one of our advisors would be, and we can go from there. Question from Mukesh. How do I go about arranging finance for buy-to-let? Well, we have an in-house mortgage brokerage. We're an independent advisory firm. We deal with all of the lenders in the market that deal with brokers. So we can help you with that. You're much better off using a broker than trying to do it yourself. The reason I say that is over half of the products available in the UK buy-to-let mortgage market are only available through brokers. Also, the worst thing you can probably do is go down the road and speak with your bank, your high street bank, because they are the least flexible lenders. So they only really want to take the least amount of risk. They're not buy-to-let specialists. And quite often, you're much better off with a buy-to-let specialist than a high street lender. So more than happy to help you explore your finance options, Mukesh, and that will probably help you determine what your buying ability is and all those sorts of things. So happy to help you with that. Question from Dawn, is it better financially to flip or rent? Well, there's no one correct answer to that question, Dawn. It depends on your situation. When you say flip or rent, it's not necessarily one or the other, because I suppose an alternative to flipping, so for those who aren't familiar, the term flipping means selling. So, to buy a property and then to flip it once it's increased in value. Usually, assuming it's a good property, a better option than flipping is to remortgage, to release equity and buy more property. If you've bought a good property in a good area with strong driving factors, it usually makes sense to keep that property and to build the portfolio. Because quite often, if you sold that property today and you went back in 5 years, that property is likely to be worth quite a bit more than what you sold it for. So that's an opportunity you've lost. So it all depends. So Dawn just made another comment there. You've bought properties cash, but area not brilliant. Well, I'd encourage you to buy in better areas. The fact that you've said the area you're buying in isn't brilliant is a bit of a red flag to me. Anyway, but that might be your strategy. Maybe you're buying cheaper properties and you're making them slightly better and flipping and getting out of them because maybe the rental market isn't that great there. For example, there are some areas in the UK where you can do that. You can buy houses for 50 grand. You spend a little bit of money on them. You sell them for 80 or 90. And you wouldn't really want to rent them there because the target market isn't great. There's lots of different ways to make money from property. I'm not saying what I've described to you today is the only way. I'm saying I'm quite confident it's a very good way for passive investors. But what seems, Dawn, you're a bit more hands-on by the looks of what you've said. Question from Ash. Could you explain how mortgage lending works through a company? Good question. So companies have become very popular since Section 24 was announced. Section 24 is the changes with regards to the tax deductibility of buy-to-let mortgage interest. That change is quite misleading in the way that it's worded, because effectively what it means, you still receive a tax credit at 20%, which means that if you're a 40% taxpayer, so if your income is higher than 50 grand a year and you own properties in your own name, your buy-to-let mortgage interest is half as tax deductible as it was before. If you're a basic rate taxpayer, so you earn less than 50 grand a year, you're not actually affected by Section 24 at all. But I'd say probably most landlords are higher rate taxpayers. And therefore, most landlords are now buying through limited companies because it avoids Section 24 altogether. So to put some figures to that, before Section 24 was announced, only 5% of buy-to-let mortgages were for limited company, new buy-to-let mortgages. In the final quarter of last year, over 70% were. So most people are now buying through limited companies. So it was a very small market. It's now the bigger market so far as new mortgages go. And therefore, a lot more products have become available, a lot more lenders have entered the market. And answering your question, Ash, it's not very different at all to getting a buy-to-let mortgage in your own name. The only difference is that the entity they're lending to is not you, it's your company. And you need to give a personal guarantee on the loan that you're taking out. The reason for that is otherwise you could just walk away. Now, some people get concerned about the personal guarantee, but it's no different to buying in your own name. When you buy in your own name, you give a personal guarantee because you own the property and they're lending to you. With the company, they're not technically lending to you, they're lending to your company, but you do need to give a personal guarantee that you're going to back up the loan. So that's how it works. Very, very similar. You go through the same process as getting a mortgage for yourself. It's just that it's a slightly different product and it's lending to the company. So happy to help you explore that in more detail. Question from Taha, what are the current mortgage rates and ranges for specialist property brokers? Are you asking the fees from a broker? Fees from so I think that's what you're asking, fees that brokers charge. They range. Some brokers don't charge any. We give advice for free. We charge a £250, excuse me. So we give the advice for free. We then charge a £250 application fee to submit an application for you. And then once we've gone through that process and we've got you an offer, we charge £500. So it's £250, £500, total of £750. That's how our fees work. And I'd say that's pretty average. Question from Ash. Could you say more about using a SAS pension to release funds to invest in property and how that works? Okay, so a SAS pension is a self-administered small scheme. It allows you to take your pension and effectively take control of it. You have full flexibility on what you can invest it in. You can't invest it in residential property, but you can lend the money from a SAS to a limited company that you own or that someone else owns, and then invest it in property. So in short, that's how it works. My book covers that in a little bit more detail. I'm not a specialist in setting up those structures, but I do know what you can do with them. And I'm definitely a specialist in what to do with cash when it comes to investing in property. So in short, that's how that works, Ash. It's something that probably doesn't make all that much sense to do unless you've got a reasonable amount of money in your pension. You probably want to have a pension of 100, 150 grand plus to make that worthwhile. Otherwise, the fees might be onerous because there are costs in setting up that structure. If one has a credit score of 807, will banks be lending? Will banks be lending to be honest, Joy, I'm not all that familiar with credit scores. We work mainly in the buy-to-let space, and one thing that I know is that the buy-to-let space is a lot more flexible than the residential mortgage space. I'm not sure. Are you saying that you've got bad credit or good credit? I'm not really sure because I'm not familiar with the scoring system. I'm the principal of our mortgage brokerage, but I don't actually write mortgages myself anymore. We have a team that does that. So I suppose the only way I can answer your question is assuming that you're saying you have some sort of credit issue. If you do, then there are lenders for you. There are lenders and specific products for people who have had blemishes on their credit file. Or if it's a good credit file, then of course, everyone will lend to you. Good. Okay, guys. Well, unless there's any other questions, we will finish up here and allow you to go off and enjoy your evenings. As I say, you'll receive those text messages and emails shortly after this ends. So please do feel free to take advantage of that. And I hope that we can be of some benefit to you all. I hope that you found this useful and that you can, that you're walking away with some value and hopefully we can offer you some more value. Great. Thank you very much for your time. Enjoy your evening and I will end the webinar now.